Sri Lanka's cumulative trade deficit for the year 2018 widened to $10.3 billion in comparison to the $9.6 billion recorded for the year 2017. However, the cumulative trade deficit widened at a slower rate in the month of December 2018, supported by a significant 15.3% year-on-year decline in import expenditure. Imports were recorded at nearly $1.7 billion during December 2018, witnessing a second consecutive decline reflecting the impact of restriction on personal vehicles and non-essential consumer good imports. The depreciation of the Sri Lankan rupee may have also contributed to the curtailment of imports. Merchandise exports witnessed a year-on-year growth of 1.4% to nearly $1 billion in December 2018, mainly with an increase in exports of transport equipment and textile and garments to the US and the EU. The earnings to petroleum products, which performed well for the 11 months of 2018, declined in December 2018 due to the lower quantum of light oil exports. Earnings from tourism rebounded strongly, registering a year-on-year growth of 4.8% to $475 million in December 2018, recording an overall $4.4 billion for the year, whilst worker remittances declined by 13% year-on-year to $584 million in December, totaling to $7 billion for 2018. Foreign outflows from the government securities market continued during December 2018, which increased the cumulative outflow from government securities to $990 million for the year 2018. Resultantly, the balance of payment position recorded a deficit of $1.1 billion during the year 2018, as opposed to the surplus of $2.1 billion seen in the year 2017. The Manufacturing Purchasing Managers Index declined to 50.6 in February compared to 54.4 in January, indicating an expansion at a slower rate in manufacturing activities. This was mainly driven by the decrease in new orders and production in the manufacturing of textiles, wearing apparels, leather and related activities. Stock of purchases also declined in line with the decrease in new orders and production. However, a slight improvement was witnessed in employment with the recruitment of new employees to enhance the business activities for the upcoming seasonal demand. Similarly, the service sector PMI was recorded at 53 in February from the 55.8 recorded in January 2019, mainly due to the slower expansion in new business activities compared to January. The expansion in business activities was seen mainly across financial services and transportation subsectors due to technology improvement and expansion in export volumes. New business expectations for activities slowed down due to uncertainty seen in the business climate. Further, expectations seen in wholesale and retail subsectors deteriorated due to the new vehicle duty reforms produced in the Budget 2019. Thank you for tuning in and do join us again next week for another update.